Ashwin Patil is now with us. One side adjustment will be what happens to the debt funds. Ashwin Patni, head products and alternatives at Axis AMC, is with us. Sir, could you firstly thank you for taking out time for us? Could you talk to us about what is the real impact as far as this change in tax is concerned, where it will be treated as business income and not as LTCG? What does this essentially mean? And was this one of the reasons why product was attractive versus other products?
So let's take a step back to understand the change, as you rightly asked. So what we have historically had a regime is that mutual funds come under capital gains regime, and there was a distinction between equity oriented and other than equity oriented, and all debt funds and a few other categories which include sort of commodity, global equities, and certain hybrids were classified in what we used to call other than equity. Now, these products used to get long-term capital gains if you held them for longer than 3 years, and also got certain indexation benefits. The change that we are talking about subsequent to the passage of the finance bill, which will come into place from the new financial year, which starts 1st April 2023, is that any fresh investments that you make in these categories incrementally, if you redeem those fresh investments that you incrementally make after 1st April, then the taxation on that will not get LTCG and indexation benefits. So essentially it will be STCG, which effectively means that it is at the marginal tax rate of the individual concerned. So it's a meaningful change, of course. It does, in the past, the capital gains regime plus the indexation used to make it quite an efficient post-tax solution for investors who are looking to make long-term allocations. The fact that this has changed means that investors will need to relook at their allocations as well as their assumptions around what kind of post-tax returns they would achieve by making these investments.
So, when we just talk about the end use, you all raise funds for a purpose, and that purpose is to give money ahead, right? So, what happens to that? I mean, there are a lot of players that do take a lot of money from those markets. Do you think the cost of borrowing for these players would increase? Because, see, not everybody is investing for tax. But if there is a cost, then definitely that will be passed on going ahead. You think investor return expectation would increase?
So I'll take your question in two parts. I would say what happens at the level of the borrowers or the wholesale part of the economy, and what happens in terms of the investor side of the economy. I would say that if I were to look at the borrower side, I think there will be some amount of readjustments that would take place. I'm not too worried about the readjustments leading to any kind of meaningful dislocation. I think ultimately savings flow into the right instruments. Some of them could be intermediated, some of them could happen through banking system, some of it can happen through the mutual fund system, some happen through insurance. So these things keep changing, and ultimately savings find their way into where they're needed in terms of the right borrowers. So that part, I think there will be certain readjustments that the economy is well placed to make, not too worried about that. Where, yes, definitely adjustments will happen is on the savers side. Savers will need to revisit what is it that they were expecting from these instruments, to the extent that many of these categories have gotten hit. What you're rightly saying is that for certain categories, investors may now expect a different return profile for them to look at allocating. In some other cases, they may continue to invest with the same assumption. So yes, I think this will affect investor decision making going forward. The good thing is that the existing book is not affected, and people should note that. It's very important to note that existing investments do not get affected by this, only incremental term. But yes, we do expect them to start looking at risk return post-tax. How does this affect? And I feel that that will change some of the decision-making matrix for investors going forward.
Right. Mr. Patni, this is Vinny joining in the conversation as well. Could you just help us understand that how could one actually now start taking an advantage of in terms of the debt funds as well as the international funds then?
So I think two parts. One is there is a more immediate sort of an opportunity because we know that the new regime falls in place from 1st April. So to the extent that people have liquidity, there are some things that they need to do within this financial year. I think there is a very small window available to people in the next few days to sort of make sure that they are correctly positioned. The other part is that going forward, they will need to think more carefully about the horizon of investments and how is their sort of tax implications of some of these investments. So the longer term, of course, we can see, but more immediate one, definitely within the next few days, within this financial year, there is a very short window which is available. So I would urge people to who have either liquidity or who have been looking at allocations to use this window very carefully and very urgently to make sure that they are correctly positioned before this financial year gets over.
Right. Sir, just one quick question before we wrap as well. Just wanted to understand, I mean, you've been tracking debt, I'm sure, for really a long time. Globally, you think first time in 15 years, rates are so high that it is looking pretty attractive? I mean, if you were an equity plus a debt manager, you would be tempted to invest, especially global investors, 7, 8%, 6% inflation, 5% dollar yield. How do you rate the situation in the last 15 years?
So I would say, looking at it locally in the Indian context, actually, to be honest, we have never had the kind of extraordinarily low rates that the Western economies have had in the last 15 years. I think other than the last 2 or 3 COVID years, which were very special situations, for us, the typical yield environment has actually been pretty okay. So the first point is yes, yields on a nominal side have gone up, but if you compare this to where we were, say, 5 years ago or 10 years ago, I think we are seeing in the same track. In any kind of fixed income decision making, what really has to come into the picture is what is the expectation on inflation, because net nominal returns are not useful by themselves. You have to also look at real returns, which is basically your nominal yields minus the inflation or the expected inflation. And that is where the uncertainty or people sort of think that people are looking at, because we've now had a situation where inflation has been very stable. Even in India, historically we've had an inflation problem, but I think since 2014-15, we've had a pretty stable inflation regime. So for us also, this higher inflation has been something that has affected market expectations. So on the whole, I think the market nominal yields are good. However, people need to see the net real yields. Inflation probably is at a situation where we are starting to see some, thanks to the rate hikes, thanks to the slowdown in the economy, I think there are some signs of it stabilizing and probably coming back down over the next 6, 12, 18 months. And accordingly, I think these kind of yields could become quite attractive as inflation starts trending back into more sustainable path that it has. So it's a long answer to your question, but to summarize it, yes, for investors who have the patience and the holding period, current yields could be quite attractive.
Okay, thank you so much, Mr. Patni, for joining us this afternoon and giving us an understanding on all of that. But let's